On Thursday, LoanDepot, ticker symbol LDI, had a rough trading session. The stock fell by 44 cents, closing at $4.11 per share. That's a decline of nearly 10% in a single day, about 9.67% to be precise. For a stock that's already small cap and relatively volatile, that kind of move isn't unheard of, but it still raises eyebrows, especially since LDI has been in the spotlight recently as one of the housing names drawing retail attention. So what happened? Was there some major news we missed? A regulatory filing? An earnings warning? Actually, no, there wasn't a sudden bombshell headline that explains Thursday's decline. Instead, the story looks like a combination of two things: insider selling and profit-taking after a strong run. And when you put those two factors together, you can get a sharp pullback like the one we saw today. Let's start with the insider activity, because that's the part that tends to spook investors quickly. Over the past couple of weeks, we've seen disclosures showing that LoanDepot executives, including the CEO, sold significant amounts of stock. Now, insider selling by itself is not always a negative signal. Executives and directors often sell stock for personal reasons, to diversify, to cover taxes, or simply because they don't want too much of their personal wealth tied up in one company. But the optics matter. When retail investors see insiders cashing out, particularly right after the stock has rallied, the knee-jerk reaction is often, do they know something we don't? And that psychology can be powerful. In a name like LDI, where much of the recent momentum has come from retail enthusiasm sparked by Citron Research's bullish call and Reddit chatter, confidence and perception drive a lot of the price action. If that confidence wobbles because insiders are seen selling, traders may decide to head for the exits, at least in the short term. Now, layer on top of that the reality that LDI had been on a strong run recently. Remember, just days ago the Fed cut rates by 25 basis points and signaled that as much as 75 basis points in additional cuts could come before the year is over. That's a big macro tailwind for mortgage lenders and servicers. LoanDepot rallied on that news, climbing to the mid-$4 range and even beyond in some intraday action. The Citron report, which argued that LDI's servicing portfolio alone was worth about $5.50 a share, gave traders a clear target to latch onto. The stock had momentum, and sentiment was positive. But when a stock has a run like that, it becomes vulnerable to pullbacks. Traders who bought in at $3.50 or $4 flat see an opportunity to lock in quick profits. If enough of them hit the sell button, the momentum can swing hard in the opposite direction. That's what profit-taking looks like in practice, and it's often amplified when there's already a cloud of insider selling hovering over the narrative. So Thursday's nearly 10% decline was likely a combination of those two dynamics: insider sales sparking caution and profit-taking accelerating the downside. Importantly, though, it doesn't look like there was some fundamental shift in LDI's business overnight. The bullish and bearish cases remain largely the same as they were a week ago. Let's take a step back and revisit those fundamentals, because they matter for anyone trying to understand where the stock might go next. LoanDepot is one of the largest non-bank mortgage lenders in the United States. Its core business is originating mortgages and servicing them. The servicing portfolio is what Citron Research highlighted in its bullish note, estimating that it's worth more than the current stock price all by itself. That's where the hidden gem narrative came from. In its most recent quarterly results, LoanDepot showed progress. Revenues were up, margins improved, and net losses narrowed compared to previous quarters. The company ended the quarter with about $409 million in cash, which provides stability, and Anthony Hsieh, the founder, is back as CEO, adding leadership consistency. None of that changed on Thursday. The financial story is still the same. What did change was sentiment. And sentiment is always fragile in stocks like LDI. When the news cycle is positive, a Fed rate cut, a bullish analyst report, or retail chatter trending on Reddit, the stock can surge. But when the news cycle shifts, insider selling headlines, a perception of overheated momentum, or just broader market risk-off behavior, the stock can tumble. That's exactly what we saw today. So what should investors make of it? Is this a warning sign of deeper trouble, or just a blip on the path higher? Here's the optimistic but measured view. First, insider selling should always be taken with context. Yes, it can signal lack of confidence, but it can also be routine. Executives have personal reasons to sell, and often they're subject to pre-scheduled selling programs called 10b5-1 plans. Unless there's a pattern of insiders selling aggressively right before bad news, Insider sales by themselves don't mean the business is deteriorating. Second, profit-taking is normal and even healthy. No stock goes straight up. Pullbacks shake out weaker hands and set the stage for longer-term holders to establish positions at better prices. If you believe Citron's valuation case that the servicing portfolio is worth $5.50 per share, then Thursday's close at $4.11 looks like a discount, not a disaster. Third, the macro backdrop hasn't changed. The Fed is still easing. Mortgage rates, while sticky, are likely to trend lower if the Fed continues cutting. That supports refinancing and origination volumes, which supports LDI's revenue and servicing income. If you're bullish on housing activity picking up, then Thursday's sell-off could actually be seen as an opportunity. Of course, we can't ignore the risks. LoanDepot is still not profitable. It's sensitive to interest rates, and the mortgage market doesn't always move in lockstep with the Federation. If long-term Treasury yields stay elevated, mortgage rates may not fall as quickly as bulls hope. Affordability remains stretched, inventory is tight, and consumer confidence is still uncertain. All of those factors can cap how much benefit LDI gets from Fed cuts. There's also execution risk. LoanDepot has been cutting costs and streamlining operations, but it still has work to do to get back to consistent profitability. If expenses creep higher or if origination volumes disappoint, the bullish case weakens. So where does that leave us? Here's one way to frame it. Thursday's drop was painful, but it was also explainable. Insider selling and profit-taking are part of the game, especially in small-cap, sentiment-driven stocks. The fundamentals didn't change, the macro story didn't change, and the valuation case is still intact. That means the long-term thesis for LDI remains on the table, even if the short-term ride is bumpy. And here's the bigger picture. We've seen this movie before with other retail-favored stocks. Opendoor, ticker OPEN, has had its share of wild swings too. Retail enthusiasm, vocal advocates, and macro catalysts drive the rallies. Insider sales, analyst skepticism, or profit-taking drive the pullbacks. Volatility is part of the package. But over time, if the fundamentals improve, the trend can still be higher. So the real story behind LDI's rough Thursday isn't that something is broken. It's that confidence took a hit because of insider selling headlines, and momentum reversed as traders locked in profits. For long-term investors, the key is to separate noise from signal. The noise is the daily price action. The signal is whether LoanDepot continues to narrow losses, strengthen its balance sheet, and benefit from a friendlier interest rate environment. If it does, then Thursday's pullback could end up looking like just another bump in the road. If it doesn't, then the risks will become clearer over time. Either way, this is not the end of the story for LDI. It's just another chapter in what's shaping up to be one of the more intriguing retail-driven stock narratives in the housing sector. So, to wrap it up, here's the takeaway. LoanDepot stock dropped nearly 10% on Thursday, closing at $4.11. The likely culprits were insider selling and profit-taking after a recent rally. But the fundamentals remain the same, the Fed is still easing, and the servicing portfolio is still seen by some as undervalued. For investors willing to stomach volatility, that combination means Thursday's pullback may not be a red flag, but rather a reminder of what makes small-cap retail favorites so volatile and so interesting.